All right, I like this slide as this shows which factor or which asset class performed the best in the corresponding year. So all the different colors represent a different asset class. And as you see, it starts in 2007, left to right, all the way to 2021. And so as you see in 2007, the best asset class was momentum. So momentum stocks or momentum equities, then they did 17.8%, followed by defense equities of 17.7. So on and so forth throughout the years. What this highlights really is just that the market in which sector can vary across years. So I like to actually draw a line from last year, which was value did 29.2%, but in 2020 you said it did minus 0.2%. And then if you keep trying to draw the lines here, you'll see that it can be a little bit volatile over time. So the whole goal of what this is trying to show is that being diversified can help reduce volatility in a portfolio over time. All right, this chart shows intra-year stock market declines in the S&P 500, and those are in the red dots on the bottom, and as well as the market's return for the full year, and that's the gray bar that it's represented here. And so overall, this chart makes it clear that the market is capable of recovering from pretty big intra-year drops over time, and they can finish the year in positive territory, actually, which hopefully can be encouraging to investors to stay the course when markets get choppy. So just to look at some examples here, let's pick a year in 2020, for example. The market dropped 34% intra-year, but finished 16% in the positive territory. Pick another year, for example, even in big years. So in 08-09, the market was technically down 49% intra-year, but still climbed back a bit and ended 38%. That was a bad time, but it came off its lows. And so looking at the averages, the average, it will drop 14% at its intra-year lows. And annual returns were positive 32 out of the 42 years, according to this chart, looking back to 1980. All right, I like this chart. It's pretty simple to understand, and it's just good to know this number. What it shows is the number of days the S&P 500 has had greater than 1% moves in a day. And so it goes back from 2009 until 2021. And what it shows is the orange line is that the average over this time is 62 days that the S&P 500 will experience a move of greater than 1%, either up or down. 2020, just looking at the numbers here, was a pretty volatile year. 2021 was just under the average. And 2022, we're probably off to a pretty good start here as already. So it's just good to know that the market can move up and down throughout the course of the year. All right, it's human nature to want to avoid stock market declines at all costs, but declines are an inevitable part of investing. And so a little bit of history and background can help put just stock market declines into perspective a little bit. And so what this chart shows is both the S&P 500 and the Dow Jones average, and historically over time from 1942 until 2021, the types of declines here, the average frequency, the average length, and the last time it occurred. So if I just look at specifically the S&P 500, the type of decline is 10% or more. So that happens about every 16 months. And the average length, what that means, so 132 is the 32 days is the average length. And what that measures from is the date of the market high to the date of the market low. And then it assumes that it recovers 100% of the value. So it takes 132 days on average for it to recover from its low. And the last time that happened, it was obviously in March of 2020, the coronavirus COVID crash event. But it's good to just kind of keep into perspective that bigger drops are longer frequencies out there. But shorter days than maybe most people might think to recovery. So just good to help keep in mind and keep in the perspective of market declines. All right, I like this as a final chart to end on. as investing in the stock market can be very volatile. And for this reason, it's important to keep proper perspective when stocks rise or fall over short periods of time, because history has shown that the odds of achieving a positive return are dramatically increased the longer the investment horizon. And so what this shows is the probability of a positive return on certain time periods from the S&P 500 dating back to 1937. And so the probability of a 1 day return in the positive territory is going to be 53.4%. So it's basically 50-50 that a day to day it's going to be positive or negative. So obviously slight towards the positive. But as you keep going, 1 month, it's 63% probability that it's going to be positive. And as we move on, over a 3-year average, you have 87% chance, a 3-year time frame, the S&P 500 is going to be in positive territory. So on for 5 years, and what's great to see, a 10-year time horizon, which time goes faster than we think. You have a 97.3% probability for the market to be in a positive territory in that time frame. So day to day is tough to know where the market's going to go, but over time, your probability of success gets greater and greater.